Good morning, everyone, and a
Morning.
warm welcome to all our participants joining us for today's session on Precious Metals Market Dynamics 2026. With a $1 million question in mind, will the glitter stay bright? Before we begin, a quick word about metal trends, the platform behind today's session. Metal Trends was created with a simple vision to bring credible, independent, and insight driven conversations to the commodities world. Our goal is to connect market practitioners, industry leaders, and domain experts with a wider community that values clarity, foresight, and informed decision making. Today's webinar reflects that mission perfectly. We would like to acknowledge MCX for their generous support as a knowledge partner. Their continued encouragement strengthens our efforts to build high quality practitioner driven content for the metals ecosystem. We look forward to their continued support in our upcoming series as well. As we close the chapter on 2025, the year has indeed been a defining one for precious metals. Gold surged nearly 60%, touching historic heights and reaffirming its role as the ultimate store of value amid uncertainty. Silver, ever more mercurial, not only mirrored gold's strength but at many points outpaced it, signaling renewed industrial demand and investor enthusiasm. Behind these remarkable moves lie deeper shifts in monetary policies, inflation's expectations, central bank behavior, and the geopolitical landscape. The precious metal narrative today is no longer just about price. It is about positioning in a world that's redefining value, energy, and security. And that brings us to the central question of today's discussion. Will the glitter stay bright in 2026? To help decode this evolving journey, we are privileged to host some of the respected voices from across the precious metal ecosystem. Mr. G. Chandrasekhar, co founder of Metal Trends, senior journalist and commodity specialist. Mr. Vikram Dhawan, head of commodities and fund manager at Nippon India Mutual Fund. Ms. Rajni Panikar, executive vice president, commodities and global markets, Philip Capital India. Mr. Gnanasekhar Tyagarajan, founder, Comtrends Research. Mr. Shivanshu Mehta, senior vice president and head, Bullion MCX. Mr. Hiren Chanderia, managing director, Middle East and Asia operations, Monetary Metals UK. We are honored to have each of you with us today, and we appreciate your time and participation. It's a pleasure to have a mix of audience comprising of investors, traders, dwellers, and industry professionals with us. We welcome you all and thank you for taking the time to be here. Before we proceed, a gentle reminder, please post your questions in the chat box at any point. We will take them up during this question and answer session towards the end of the presentation. Our opening speaker is Mr. G. Chandrasekhar with decades of experience analyzing global commodity markets. He will set the stage with a comprehensive macro landscape for gold, silver, platinum, and palladium, offering the perfect foundation for the conversations ahead. Chandrasekhar ji, over to you.
Oh, thank you, Binaben, for that wonderful and inspiring welcome speech. We are discussing today precious metals market dynamics, how are things going to evolve over the next 3 or 4 months. First, let me start with a disclaimer. I'm not a trader. I don't hold any trading position anywhere. I'm a student of the market, and from that perspective, I'm going to speak about what I see as the market dynamics and the likely trends that are going to happen over the next 3 or 4 months. When we discuss precious metals, we are discussing gold, silver, platinum, and palladium. These occupy, after all, we all know very well, occupy an important place in our commodity ecosystem. That's the first proposition. Then silver, platinum, and palladium, but in particular, are increasingly used in industrial application. Therefore, they are just not precious metals. They double as industrial metal is something we need to remember, particularly in this time of energy transition. Now, perception about the precious metals is changing because we live in a world with a huge amount of uncertainty. What is called VUCA world: volatility, uncertainty, complexity, and ambiguity. The world is facing geo-economic uncertainty and geopolitical instability. We are in an era where decarbonizing is happening in an accelerated fashion for energy transition, and we are living in a world that's constantly marked by evolving high-tech devices in diverse areas, whether it is defense, space, healthcare, mobility, that use all these precious metals. I think that's the background that we need to remember. That's the first proposition I want to make. And as Bina said, yes, this year gold has extraordinarily outperformed other metals. 60% rally year to date in 2025, and that's the best since 1979. What does it reflect? It actually reflects structural, fundamental, seasonal, and sentiment driven demand, is what my reading is. And it also actually underscores gold's unique role as both a hedge against geopolitical stress and a store of value in times of policy and institutional uncertainty. Now, Fed's role in resuming interest rate cycle is also going to have an impact. The meeting is on the 10th. What is likely to happen? The market has already taken cognizance or believed or factored in that there is going to be a further decline for the rate cut of 25 BP, but be that as it may. I don't know. We don't want to speculate. But historically, gold has actually outperformed during easing cycles. This is something we need to remember. For it is in this background that we need to look at gold going forward. My outlook for 2026 is very constructive for gold when we go into 2026. It's a mix of structural shift and macro factors. There is no doubt at all. And this also includes the Fed on an easing cycle, right? And then I would think, not I would think, I see a lot of experts, including top bankers, etc., they all guarantee, they all assure us that gold prices will remain elevated in 2026. This is the overall kind of consensus view around the world. But I usually take a contrarian, okay, and I'll tell you why. Because I think gold is facing headwinds, and it is likely to face headwinds. Factors that can potentially derail gold's rally. It is not just one-way street, and we saw that during Diwali. It's not a one-way street. It is amenable to correction. It is vulnerable to correction. And what are those factors, multiple factors, which can potentially derail? I'm not saying gold rally will be derailed, but there are factors which we must remember. One is monetary policy. Very, very clearly, if inflation proves to be stickier than expected, major central banks can possibly pause rate cuts is one thing which will remove a support system for gold. Second is the US dollar. I think, and I am hoping, and I won't be surprised if the US dollar rebounds because of improved US's economic growth and capital inflows into the US, which will make not gold but USD as a safe haven. It's again a possibility. I'm just building scenarios. Central bank buying. In 2024, central bank globally bought, if my memory serves me right, about 1,100 tons. In 25, it's less than 1,000 tons. Okay, we don't know whether there's a demand slowdown. There is reason to believe, if we go by numbers, there is certainly a demand slowdown visible as far as central bank purchases are concerned. I won't be surprised in 26 if there is improved forex stability, which can also further slow down demand for gold as a safe haven. Geopolitics, which has certainly helped gold in the last 3 or 4 years, definitely. But there are incipient signals of tensions easing. These signals are clearly visible to all of us. Both military war and trade war. There are two wars happening. Both are seen easing. At least my view, it is certainly easing, and therefore it can potentially reduce gold's safe haven appeal. And last but not the least, let's be honest, we can't wish it away. The physical demand for gold is weakening. Even China's imports are falling if you are looking at the numbers over the last 2 or 3 months. Therefore, the point I'm making is gold has rallied, given extraordinary returns, but don't assume blindly that it's a one-way street. It may not be a one-way street. This is a caution I want to give to all the investors, particularly retail investors. I'll come to silver. Silver again is obviously stellar outperformance. Year to date, possibly close to 100% is the increase. And it's very strong growth or performance in recent decades. And the best part is its outperformance has outpaced other precious metals, including gold. The very interesting part of silver. And therefore, that the surge in silver prices, in my view, actually reflects very severe market tightness. This is the fifth year where silver market is in a state of deficit. And then you also have macro tailwinds and spillover strength from gold. As we all know, your silver always draws strength from gold. And again, for silver, the medium term picture, in my view, is quite constructive. And therefore, silver benefits more than gold because of its dual role as both precious metals and industrial metals. And therefore, the consumption of silver is actually in the real economy, and it's a real consumption. It is actually used because of its strong industrial demand from solar industry, electric vehicles, electronic sectors, etc. That's what underpins the consumption story or demand story, the real demand story for as far as silver is concerned. Therefore, silver prices can potentially stay elevated, but please be careful. Please be cautious with volatility. Is a kind of word of caution that I want to give. And next 2 minutes, I just want to, even 1 minute, I want to talk about platinum and palladium because we have experts who are going to discuss all of this. But let me just complete the platinum and palladium. Both these are categorized as precious metals, but again, they have industrial uses used in automotive sector, in electric catalytic vehicle catalytic converters, etc. All of us know where they are used. But the best part is both are supported by supply concerns. There are supply concerns relating to platinum and palladium. Fabrication demand side of the equation, in my view, is not particularly strong. It is something we need to bear in mind. Supply concern on the one hand, and fabrication side of the demand is not really strong. And more important, those with interest in palladium should know it's a highly volatile exchange traded commodity, and therefore in 26, my expectation it can potentially witness very large swings. And only recently I read that China has launched platinum and palladium futures, physically settled futures contract. To what? And that, in my view, is going to trigger a lot more trading, a lot more physically settled contract, which will actually get utilized in all those electric vehicles, solar, etc. Therefore, overall, at least the early part of 2026 looks very positive for all the precious metals as a group. Gold obviously will face some headwinds, which is my way of looking at it. Silver, yes, it is structurally imbalanced, and therefore it will continue to. The market dynamics are very constructive, and therefore one can expect a certain price appreciation. And I think with this, I will stop here. I will leave it to all my expert co-panelists to share their thought. Good luck. God bless you all.
Thank you, Mr. Chandrasekhar, for that clear and compelling macro backdrop, a thoughtful roadmap to forces now shaping bullion markets. Building with this backdrop, it's my pleasure to introduce Mr. Vikram Dhawan, with over 2 decades of experience in global commodity markets in Europe and Asia. He's the head of commodities and fund manager at Nippon India Mutual Fund. He has previously held positions at the Bank of Nova Scotia, and Rothschild and Sons, Vedanta PLC, the Aditya Birla Group, and Nippon India. Is aptly leading voice on commodity strategy and ETF dynamics. Today, he'll decode how market signals and ETF flow are changing the gold and silver landscape. Mr. Dhawan, the screen is yours. Thank you.
Thank you, Bina, and thank you, Mr. Chandrasekhar, for inviting me on this amazing panel. I think the question we should be asking Hiren, what is the AQI in London? You should be telling us that. That is the most important question. Hiren, are you there?
Yeah, hi Vikram. Okay, I had pleasure of working with almost all of you, either as a counterparty or with you as colleagues. So it's great. Yeah, it's pretty good right now. It's
okay, so we are at 200. So we are ahead of you. Mumbai is at 195 AQI. We are much ahead of you. So, so yeah, good to see Hiren and good to see Shivanshu. How are you doing? You're traveling, Shivanshu? Rajni, we have not been introduced, but hi to you and everybody. And Chandrasekhar obviously is the granddaddy of the commodity market.
Oh my God.
So, well, still younger than me, but it's a good. I think there are not too many participants, but I think use this opportunity to learn because Rajni said that she likes to keep quiet when there are great people speaking. So I am not one of them. You can speak while I'm speaking, but for the rest, you'll have to keep quiet and listen. But I think use the opportunity to learn from such a galaxy of people, excluding me, who are on the panel. And I think let's make it a bit more interactive. Feel free to ask questions, or if you have, I mean, we may not open the mic, but if you pop up something on the chat box, I can immediately veer my extempore presentation to that. So do that. I mean, use that. It's more like a one-to-one. It's like a Harvard Business School where the ratio of teacher to student is one of the best in the world. I mean, Hiren has gone to one of them, so he'll probably know better when he speaks. So yeah. So again, just to counter Mr. Chandrasekhar, what you said about gold and silver.
Yeah.
I think when we started this fund in 2000 together with Hiren and I, November of 2007. Hiren, you remember? So
yes, I remember very well under your guidance.
Well, that's very kind of you to say, but I had no idea. Well, we both had no idea what we were getting into it, but I think thanks to your hard work and everything, we learned a lot. The learning curve was very, very steep in that. We knew gold, we knew commodities, but ETF was invented in 2005, and I think one of the occasions where the regulator was so so proactive that within 2 years it was launched in India. It's it's actually a case study that how soon. Yes, sir.
Yes, Vikram. Do you remember the first ETF in India, Benchmark by Rajan Mehta?
Yeah.
I launched it at the BSc, but now I can't remember the year. It would have 2004, 5, 6, 7, 8. I don't remember. But I helped them launch that first ETF on gold. The fellow's name was Rajan Mehta. If I remember correctly, the firm was Benchmark. And it was launched at the BSc. Anyway, okay, just as an aside, please go ahead. Yeah.
I think I and Hiren will contest that because we both had applied together, but they got the approval first.
Okay.
I think we were told that since we are a conglomerate, so I mean, we can talk this offline. Hiren, you remember, right? We had applied together.
Yeah. But just to counter, we launched the first gold savings fund, which became market leader.
Yes, absolutely. Thank you, Hiren. Thanks for that. I'll also help you in your presentation. So, well, so much of talk, but I think to counter what you said, and this was the tagline that we had when we launched the fund, that nobody got poor by owning gold and silver.
Absolutely.
And yes, prices. It's good to know that prices go up and come down, and that's the beauty. If it was stable, then probably we won't be talking about it. But I think let me spend some time on the product ETF. Because unfortunately, due to SEBI regulations, we are not allowed to give any views on the market. I'll try my best, and obviously there are many other people who can give you very profound view of the market. But let me just start with the ETF. that why ETFs have become so popular across the world. As we talk, the global AUM of ETF is in excess of $400 billion. And surprisingly, while the Indian market remains closed, this data I can share with you. The Nippon Gold ETF is now the ninth largest in the world, and the Nippon Silver ETF is sixth largest in the world. And put together, we account for roughly 1 to 2% of the global market share. I mean, local market share, obviously, I can't share the statistics because we are not allowed to. You can always check it up, and also in terms of volume. But yes, so this is something which has been thanks to the vision of the regulator and the government of that time to allow these funds to, now everything that we are doing is comparable to the world, if not better. In fact, the regulations in India are for gold and silver ETFs are a lot more stringent than what you would find in Europe or North America. Because in India, obviously, the focus of the regulator SEBI is the mandate is to protect the interest of the retail investor. They are more worried about the person putting 500 rupees, not the guy who's putting 500 crore. Obviously, it's not saying I don't care about the guy who's putting a lot of money, but I think the focus of the regulation is extremely focused on the retail investor. And also, it's a regulated market. You must have seen the lot of discussion happening online about digital gold and ETF. I mean, digital gold is a fantastic business. I have no doubt about it. But I think you have to understand what regulation means, what a regulated product is. Regulation means that today, when you buy a mutual fund, 99.9% of the times, most of the queries that you have or grievances that you have are very well covered in the existing SEBI regulations and case whatever studies whatever has happened in the past. I mean, it's past 20-25 years. Very rarely investors have to go approach the civil courts or something like that. So that is so regulation in mutual fund, risk management in mutual fund is not optional. It is mandatory. It is actually the most important thing that we do. In fact, if you see the bandwidth of any mutual fund, two-thirds of their bandwidth is actually working towards meeting the compliances and the risk management. This is the kind of focus that we have. I mean, if you look at my days, there are days when 95% of my time is spent on risk management and compliances. This is the kind of focus we have in the mutual fund. So, and the argument is that you have a lot of friends and relatives. Binaji, just prompt me if I am exceeding my limit because
No problem.
because I don't want to
No,
put
we'll have
people to,
enough time. Don't worry.
yeah, okay. I don't want to put people to sleep
It's a
in the first
poetic
place.
discussion which I won't like to cut it.
Yeah. Okay. So, I don't want to put people to sleep on a Saturday morning. So yeah. So see, the argument is that we have a lot of friends and relatives in our group, right? But why don't we give them money to manage? For the simple reason that they're great human beings. They're very honest. But for them, compliance and regulation is not something which is mandatory. They can afford to, be a bit lackadaisical in their approach. So that's why the regulation thing is very important. It's your money, it's your hard-earned money. Even if it is inherited money, somebody worked for it very hard. So make sure that it is a regulated product. You have a recourse. You don't have to run at police stations or you don't have to run to courts to get your money. That is the first thing which makes it more very attractive. Secondly, I would say ETFs, especially gold and silver ETFs, are probably the one of the best inventions in the financial sector which has happened in this century. And why I tell it is because if you see the liquidity of the ETF units, first of all, you can buy today, if you see the counter prices of most of the ETFs, gold ETFs trading, the gold is roughly about 100 plus and minus for most of the funds. Silver is about close to 200. So as you can see, single unit ETF units are as cheap as 100, 200 rupees. So you can buy very, very nominal amounts You can buy 1 unit. I mean, it's traded on the National Stock Exchange. So, but also the kicker over here is that the liquidity in such a small unit is significantly more, significantly better than the physical market. So, the best way to see what is the bid and ask spread in the physical market is when you see the prices of gold, uh, published prices of gold, and then you see the price you're getting when you're buying something through Amazon. You'll see the kind of spreads this market has, and it's not just gold; it's everywhere. I mean, you buy steel from Tata Steel directly, or if you buy steel from the corner shop, there'll always be a that's where people make money. That's why their business runs. But in case of ETF, what you're getting is the landed price, prevailing price in the Indian market, and well, obviously it will have some premiums and discount depending upon the local demand and supply dynamics. So first of all, regulations. Second of all, the liquidity. Thirdly, the ease, the convenience. Today, I think roughly two-thirds of the people do their financial transactions through apps. Now they can be mutual fund apps, they could be UPI apps or whatever, through apps. And obviously, which means that you can also buy and sell your ETF units through through your phone, basically, click of the finger. So convenience is also there. Now, I'd like to spend a couple of times on the mandate which has been provided by the regulator to the mutual fund. First of all, the mandate for gold and silver bars to be held. I mean, as per the SEBI regulations, the gold and silver ETFs in India have to be backed physically. And if there is some variation which is happening, if let's say they want to invest in some other type of gold instrument, then it can lead to change in the fundamental attributes of the fund, which has to be either communicated at the time of the NFO, new fund offer, or if the fund is already existing, they will have to inform each and every existing investor, that look here, we are no longer putting all the money in physical. We'll be also doing X, Y, Z also into it. So keep an eye on that because I think ETFs are a very good proxy for physical gold and silver, and so they are physically backed. That is one thing. But what is it the ETFs are holding? What kind of bars? Is there a standardization? So there, the gold and silver bars, which are held by the ETFs in India, have to be LBMA good delivery, London Bullion Market Association good delivery, and the market in Hiren's hometown right now. So, but what is the significance of LBMA? Why LBMA? So LBMA, first of all, 95% of the physical trades which happen across the world, they use the LBMA pricing as the benchmark. I think, except some Chinese ETFs, most of the funds. So Bina is on the line, so I think I have to conclude now, right? In 2 minutes. Okay, I'll do that. Fine.
That was a
So
signal.
2 minutes or 1 minute?
No, you can take 2 minutes. Take
2 minutes. Okay. All right. So I think the recourse, there's a lot of disincentive for the LBMA refiners to bring down the quality. So the quality and the quantity aspect, the purity aspect is very, very strict and stringent as far as LBMA is concerned. So look, so you have an instrument which is regulated, which has got more liquidity than the physical market, and it has in the ecosystem which is attuned towards retail investors, and obviously the stuff that you're holding is of the highest quality. Obviously, you please listen to the other panelists also before putting money in gold and silver. But I think I can only speak upon the product. But it is not a coincidence that gold ETFs and silver ETFs are the most popular way to take exposure to gold and silver market across the world. It is because of the attributes. And yes, I mean, if you have any suggestions, if you think we can do something better as mutual fund, feel free to put it in the chat or reach out to us. We are listening, and we thank you all of you who have invested in our funds. And thank you once again for inviting me on this panel. And sorry for it being a bit dry. I didn't show any graphs or any, which I think Mr. Tyagarajan will be showing that will be more exciting. So, but yes, thank you very much for joining on a Saturday morning. And over to you, Bina.
Thank you.
If I can add one point.
Yeah.
Just to substantiate your point, the average daily trading volumes on gold is $149 billion, which is higher than US 1 and 3 year Treasury. It's the second highest in after S&P 500. So that's the kind of liquidity we are talking about, as you mentioned.
Yeah, absolutely.
That's great. Thank you, Mr. Dhawan, for an insightful deep dive into the evolving world of gold and silver ETFs. Your perspective on flows, positioning trends, and smart allocation strategies has added tremendous clarity to how investors can navigate the next bullion upcycle. We now move from ETF-driven dynamics to a broader portfolio lens. How precious metals can be strategically integrated into modern investment framework. It's my pleasure to introduce Rajni Panikar, a seasoned professional with over 25 years in financial markets, currently leading key business verticals at Phillip Capital India, including commodities and global market access. She is widely regarded for her expertise in price risk management and her advisory roles across major Indian exchanges. Her insights are widely sought after, and she contributes as an advisor to the product committees of major exchanges, including NSE, BSE, MCX, and NCDX. Today, she will enlighten us on strategic allocation, integrating precious metals into a modern portfolio. Rajni ji, over to you. Yes, Rajni, we can now take you on the screen.
Rajni, you have to unmute yourself.
Rajni,
Unmute.
Yeah. Can you hear me now?
Yeah.
Yes. Sure. Yes.
Okay. Great. Sorry about that.
No
And
problem.
yeah, and thank you so much. Thank you for the introduction, Beena. Thank you, Gyanashekhar ji. Thank you, Chandrasekhar ji. Thank you, Vikram, and to all the co-panelists as well as all the participants. A very good afternoon. Indeed, we've all seen the headlines. The speakers before me have spoken about it. It is a talk of the town, and of course, very rightfully so, because gold is now at historic highs. The returns are stupendous. It's like up, which Beena ji has said, both Chandrasekhar ji and Vikram has said. Silver returns 3 digits, gold up 60%. Obviously, you cannot not be talking about it. And therefore, it is in 2025 is definitely what can be called as the golden year. But we've heard a lot, we've read a lot. But as investors, the prudent question for the prudent investor will always have this question in his mind. Is this a fundamental shift that we are seeing in the value of precious metals, especially gold, or is it a speculative bubble? So what I'm going to try to attempt, and I hope I'm able to succeed and add some value, is that in the next 10-15 minutes, we will try to understand and make an attempt to unpack the signal versus the noise of this rally and attempt to define a clear, disciplined strategy for gold in your portfolio. So that is the agenda that I will be trying to fulfill with my presentation. So to understand this market, I am going to use a framework which is popularized by Professor Ashwath Damodaran. He's the renowned finance professor at NYU Stern School of Business. I'm sure everybody has read him, heard him. Professor Damodaran is also nicknamed as the Dean of Valuation for his expertise in corporate finance, valuation, investment, and more so because of his emphasis on valuation, about its narrative and future forecasting. And it's just not about numbers, which is, I think, what is important, because the numbers somewhere we lose out. So it's more about the understanding how to value assets that Professor Damodaran specializes in. And I thought that it is very pertinent that we look at what he has to say and use some of his insights into arriving at how to include precious metals in the portfolio. So jumping back, the dilemma that we face for gold is distinguishing between signal and noise. The signal tells us that something real is broken in the economy, a fundamental shift in value, and therefore we need to protect our portfolios, our investment from this fundamental shift. The noise, on the other hand, is this manic energy of the crowd, which is driven by market psychology, chasing a hot asset. So a successful portfolio management requires us to respect the signal without getting swept by the noise. So getting this into context, if we look at the landscape of 2025, this just hasn't been another year for commodities. We are seeing a breakout that is historically significant. The graph shows the change in gold prices every year going back to 1963. Gold has never surged this way. It had its ups and downs over time, with a surge in prices in the 1970s, which was after it was depegged from the US dollar. And that time, the very best and the very worst year in terms of returns for gold occurred within a span of just 2 years. Gold rose 133% in 1979 and was down about 32% in 1981. In October of this year, gold has again hit a record high, not just in absolute terms, but also in terms of inflation-adjusted prices, which is what you see is the lower bar of this graph here. The inflation-adjusted price that it tested was, as can be seen, closer to $500 an troy ounce. So what makes this rally, however, for gold different from the past is the breadth of participation. It's not just the traditional gold bugs or the doom mongers buying in. We are seeing mainstream institutional capital entering the space. What Vikram spoke about, ETFs, what Chandrasekharji spoke about, central banks. And I will share details of the participation in, of course, the next few slides. The comparison, of course, is with the equity markets. While equity markets are jittery as well, high valuations, particularly in tech, AI, precious metals have decoupled. They are moving on their own narrative, which forces us to ask, what does this market know that perhaps we might be missing? Let's identify the signal, the legitimate reasons driving this rally. If we look at it in one word, then there is definitely, it can be primarily said that there is fear in the markets. There is a fear trade that is supporting precious metals. And what is this fear about? It is about the distrust first to begin with, unfortunately, about institutions. There is, investors are questioning primarily if central banks can navigate a soft landing without reigniting inflation. What does a soft landing mean? It means about bringing successfully inflation back again to what central banks usually target at 2% rate. And this requires perfect monetary policy timing. The market fear, therefore, is twofold. Over-easing, which is the inflation risk. The Fed might cut rates too soon to avoid a deep recession. If they ease while the underlying inflation is still sticky, they risk unleashing a second wave of inflation. A persistent devaluation of fiat currencies, and this is highly corrosive for standard wealth and is gold's ideal environment. The second is, of course, the fear that markets have about central bank institutions is over-tightening. Conversely, if the central banks were to tighten to keep interest rate high for too long to ensure inflation is truly dead, they will almost certainly trigger a deep, painful recession. The market sees the central bank caught between two disasters. Gold, the non-yielding asset, seen as insulated from the volatility of high inflation and deep recession, makes it a critical safety valve against policy missteps. The fiat currency is the second fear. With aggressive fiscal spending and debt monetization globally, investors are worried about the long-term purchasing power of dollar and other major currencies. And of course, the asset bubbles. Finally, many see equities as too highly priced. And if you believe stocks are in a bubble, gold becomes the classic exit ramp to safety. The elephant in the room, or the whale in the room, perhaps, which is the speakers before also has spoken about, is the central bank purchases. And as the graph explains, China has been leading the central bank purchases. Since 2009 till 2024, China has added 330 metric tons of gold reserves, followed by India at 242 and the rest of the Middle East Asian countries as well. In the last 3 years, that is from 2022 to 2024, central bank purchases have been close to 3,200 metric tons. And if you put it in perspective, that's nearly 100% jump from what they used to buy about just a decade ago. IMF puts the central bank total holdings at closer to 37,000 tons, huge numbers. This strategic shift, and central banks are definitely not holding this to just profit. It's a geopolitical strategy. It is a move towards de-dollarization, reducing the reliance on US financial system. This sovereign bid, therefore, puts a floor under the price of gold, and that retail investors alone could never sustain. Distinguishing the 2025 surge from purely retail-driven speculative bubbles is what central bank purchases indicate. Now comes to the important part, which I said about distinguishing the noise. How do we arrive at what is the value from this noise? This is, of course, the most important part of the strategy, the difference in pricing and valuation. So according to Professor Damodaran, all assets can be valued in terms of 4 different types. It's either an asset which gives expected cash flow, like dividends, interest, earnings, like bonds and stocks, or commodities, which are used as inputs for production. Currency is, of course, a store of value, and collectibles, which is held for security and enduring demand. Now, gold can or has been a currency, a commodity, and a collectible at different points in history. But the problems that we have with gold as a currency is documented. There is, of course, in terms of difficulties associating for gold as currency is the authenticity, securing, breaking down into small units. Therefore, as a currency, it in a way becomes inefficient, and which is what history also has proved. As a commodity, it is used in jewelry and other products such as, which is for in terms of tooth fillings, in terms of certain industrial metals. But when we come back, and if you see over the historical time, its value as a collected that remains undisputed, and something that governments, banks, and individuals are attaching value to it over time. Thus, we can safely say that gold's role as a collectible has driven its pricing over time. Now, given gold is a collectible, how do we determine how it is priced? Absent cash flows, gold cannot be valued in the traditional sense. Gold is therefore, as we see, priced every day in markets. And this pricing depends on supply and demand. And ultimately, a process beyond demand and supply, which is mood and momentum, which carries the day. Gold worth is determined by its momentum. What prices are markets ready to pay for it tomorrow? That is what also drives gold prices. In 2025, the pricing has been driven by mood, momentum, and the danger, which Chandrasekhar ji talked about, some headwinds, is that the pricing game can shift quickly when mood and momentum shifts. Prices can collapse, and in the absence of cash flow, it will be a difficult bottom to catch. And this is why we must be cautious. Now, to arrive, before we get into the portfolio construction, there is a pertinent question that we have to ask. If it is difficult to value it, or unlike other yield-bearing assets, if we can't value it, why buy it in the first place? So, which is something that we have historical data to show, that we need to frame gold not just as an investment for growth, but as an insurance. While gold does not have intrinsic value, there are at least 3 factors historically that have influenced the demand for gold and the prices for gold other than the market's mood and momentum. The first being, of course, its demand as a hedge against inflation. There's a very interesting study that Professor Damodaran did, so that what is often spoken about, gold as a hedge against inflation, how has what is the statistical numbers when you put it and study it? So for this, Professor Damodaran did a percentage change in gold prices and compared it from 1963 with other four assets, which is US stocks, US bills, US Treasury bills, US bonds, US real estate. And that is what the table shows us. And what it finds is that gold has had three standout decades, the 1970 to the 1980, the 2001 to 2010, and of course, the previous 5 years from 2021 to 25. With high inflation being the driver of returns only in the first and the third instances. During 2008 crisis, it was basically the mortgage crisis, which is not an inflation-led crisis, which supported gold. So what we can see is that one finding when we put it through a statistical test is that gold is more against a hedge when there is extreme inflation, rather than when there are smaller inflations, which is something that the data shows from the 1970s, because before that it was pegged, is that when there are smaller inflations, gold is not an effective hedge. But in terms of extreme inflation scenarios, couple of decades has definitely shown us that gold is a hedge against inflation. The second reason why gold is held is because it's a hedge against crisis. Throughout centuries, gold has been a safe haven for investors fleeing a crisis. So when we put this into a statistical study, what does it show? If we compare the percentage change in gold to the two forward-looking measures for investor fear. One is the default spread on a BAA rated bond, which is an investment grade but a lower grade US bond, and an implied equity risk premium, which is a forward-looking premium computed based on stock prices and expected cash flows. Then how do we read these data with gold? What it shows is that every time investor fears increase, we see these risk premiums in both equities and bonds rising, as you can see in the chart, and gold should rise in concurrence to this. The statistical study shows that when we compare this over the period from 1963 to 2025, the percentage in change in gold price to the equity risk premium has a correlation of 5%. And to bonds, it's actually non-existent of 0.20%. So as a hedge against crisis, the statistical study shows that gold has perhaps a relationship with equity risk premium. And statistically, we are not able to prove that whenever bond markets react in fear, gold will follow as well. So as with inflation, though gold's perspective as a hedge against inflation sustains, it seems that it's greatest during potentially catastrophic economic events. And finally, one of the other reasons, the third reasons that we hold it is, of course, as a hedge, as an interest play. When you're holding gold, because it doesn't yield any assets, you lose the returns that you could have made investing it in a financial asset, dividends on stocks or coupons on bonds. The magnitude of this opportunity cost is captured by real interest rates. So higher the real interest rates should translate into much higher opportunity cost and thus lower prices for gold. Again, when we put it through the period that we did for the other two studies, which is 1963 to 2004, it shows that for this, we took the real interest rate yields, which is the inflation index treasury bonds, and we took what is the real interest rate computed as a difference between the 10-year US Treasury bonds and the realized inflation rate. Then this correlation between gold and interest rate is around 22%. It can therefore be concluded that high real interest rates are negative for gold prices and low real interest rates push gold prices higher. So, I mean, to put it in a nutshell, we take away all the numbers. What is it that for a retail investor, what is it that these statistics are trying to show? In a very simple way, it says that gold or precious metals has to be included in your portfolio as an insurance. You have to treat it like a home insurance. You don't pay premium on your home insurance, hoping your house burns down so you can get rich. You pay for the insurance to protect yourself in case crisis hits. in a modern portfolio, gold or precious metal is that asset that pays off when everything else, stocks, bonds, real estate, fails. Its correlation to productive assets is often negative during crisis. That is its primary job, preserving purchasing power when the system shakes. How do we execute this? So the Professor Damodaran model says that ideally, precious metals should be about 5 to 10% of your portfolio. The discipline here is, of course, very important. Despite the noise that you will hear, despite the gains that you hear, ensure that your portfolio has precious metals. 5 to 10% of your total portfolio should be precious metal. The rest can belong to productive assets that generate cash flow. There is a rebalancing mechanism that is most important. This gap creates a natural discipline. If gold, precious metal surges beyond your allocation to say 15%, you sell the excess and buy undervalued assets. If precious metal crashes to below your portfolio holdings to 3%, this forces you to buy more. And in this way, we are able to actually practice what is a gold standard for all portfolios. You buy low and you sell high without letting emotions drive the wheel. The conclusion, the verdict, therefore, is as we wrap up 2025, the golden year, respect the signals. The macro risks, debt, geopolitics, inflation are real. You need protection. But what is the noise? Do not chase the noise. Do not buy gold because you think it will go to the moon. It is a portfolio requirement. It is a portfolio requirement for insurance. Stay disciplined, treat it as insurance, keep your allocations around 10%, and you will benefit from the protection without exposing your portfolio to speculative ruin. Thank you so much for your attention. I hope I've added value. I'd be happy to have any questions on the allocation strategies, specific market indicators. I'll be around for the Q&A. Thank you so much.
Rajani, excellent presentation. I loved it.
Thank you, sir. It means a lot.
But we'll
Very
take
in depth.
on interest rate, the relationship between gold and interest rate. Anyway, but yeah, Binaben, go ahead.
I will further take to the next one. Thank you, Rajniji, for that deep dive into strategizing modern portfolio of precious metal markets. As we gather to explore the fast-shifting landscape of commodities and forex markets, it is only fitting that we are joined by one of the most respected and seasoned experts in this domain. A true veteran of the commodity markets, Mr. Gnanasekhar Tyagarajan, brings unmatched depth and clarity to market analysis. He's the founder of Comtrends Research, an organization committed to helping corporations navigate commodity and currency risks through strategic and data-driven hedging solutions. With over 25 years rich experience, Mr. Gnanasekhar has worked closely with seasoned traders across the globe and has been associated with institutions such as Dalal Street, Dow Jones, Reliance, ITC, and Scotiabank. His core expertise spans cross-currency trading and bullion, particularly gold and silver, where his technical understanding is widely acknowledged. He has played a pivotal role in shaping risk management strategies for companies in India and overseas. His market views are frequently featured on leading financial news platforms. Today, we are privileged to have him guide us through the technical price trajectory for bullion and the dollar, a subject of immense importance. Over to you, Mr. Gnanasekharji.
Thank you, Bina, for the introduction, and thank you, Chandrasekhar sir, for inviting me in this distinguished panel. Go a long way back with most of all the panelists actually.
Chandrasekharji will talk later.
Hiren, is someone who joined us right out of business school. Got completely disenchanted that these guys are not at all using fundamentals. They're using largely technical analysis to predict direction. But I'm very glad to see where he's come today.
Thanks for that opportunity. I mean, there are many firsts here.
Yeah, pleasure, Hiren. Vikram, is someone who I didn't work closely, but then after I joined the dealing room, he had just left the dealing room in Scotiabank. But I've heard a lot about him, and I'm very glad to see his ETF has done extremely well. It's one commodity that I really follow very, very closely for a long time, and he's done a great, great job in amassing the kind of numbers the ETF has come up with. That's not a mean achievement in a country like this. So congratulations again, Vikram. Shivanshu is doing a great job. I think the exchange volumes speaking volumes by itself. And Rajni, my good friend for a very, very long time. We have been together in various platforms and really thoroughly enjoyed the presentation, Rajni.
Thank you so much, Yanshekar. It's always a pleasure.
Yeah.
To work with you, to talk with you, it's my pleasure completely. Thank you so much.
Same here, Rajni.
Yes, likewise, Yanshekar, likewise.
Thank you. All right. So mine is going to be more on the technical side, on the price direction side. So it might sound like a forecast, but it's kind of giving you a direction, because I don't want to be sounding like I'm giving some kind of a price forecast, but I'm using the prices to kind of get some direction. So that will be the focus of this presentation in the next 10-15 minutes. So kindly bear with me. I'm just getting into. Sorry. Are you able to see?
Not yet.
Guys, are you able to see?
Not yet.
Sorry. Okay. Okay. So we've seen, I've taken this particular chart because, it was from 2000 is when the rally in gold truly began. Till then, it was, kind of volatile to some extent, but a one-sided rally kind of started from 2000, exactly post the New York Twin Towers destruction. So it's been a linear kind of a move that's happened so far, and the forecast suggests that it could extend much further from here, and the underlying picture still is something of a bullish trend that continues, that doesn't show any signs of abating so far. However, in the medium term, because of the news flows and various factors that affect the market, I think there could be some tough resistances on the way. And one of the levels that one can see as a good resistance in the medium term will be around 4,700, 800. But with this momentum that the market has, because of all the factors that Rajni talked about and Chandrasekhar sir talked about, it could easily extend much higher than that. We all have seen the kind of forecasts which foreign banks have come up with. The kind of numbers that I keep hearing just is mind-boggling. But unfortunately, we don't have a past reference because gold is making new highs every day. So it becomes difficult when you don't have a past reference to connect with. So the only thing which you can rely on is some kind of a fundamental assessment and a technical projection. So the technical projections at this point in time is pointing towards 4748 as some kind of a near-term resistance where it could find it tough to cross. But again, depending on news flows at that point in time, the momentum could be strong. It could surpass that very easily. But the point is, the underlying trend remains extremely bullish, with a typical trend called every bottom is higher than the previous bottom and every top is higher than the previous top. So that's a sign of a uptrend. So if one were to look at the Charles Dow theory, that's exactly what he talks about. So that's basically what we are as far as gold is concerned. So the short-term volatility is expected, 4,400 being a cap on the upside, and we can see 3,800 to 850 as a very strong base that it's building now. So we're seeing some kind of a consolidation here, and then prices to sort of take off from there again. And the rate cut that is expected in December, and the future path is all suggesting that there is more upside. But having said that, we when we look at positives, we tend to look at the other side. So the disclaimer would be that yes, everything is sort of unanimously looking like gold prices are going higher, but there is an unwritten rule in this market that when there is unanimity, market can go completely against it. So we don't know what kind of factors could come and kind of derail this rally in gold. But one should be abreast of that. Any changes that happen, one should be very closely seeing how that could affect gold prices. But as of today, I'm not able to see any factors that could derail this rally in the short, medium term, or long term. But just going back to gold and the dollar index, that's the very key correlation that everyone has been watching for some time. Conventionally, it's an inverse correlation, but there are times, in fact, in the last 2-3 years, gold has completely gone away from the kind of correlation, and irrespective of whatever happens to the dollar, it's just been climbing one way because of all the factors that again was listed before, the Chinese central bank buying, and all the safe haven buying that has taken place. So the correlation has kind of lost. But typically what happens is when the correlation is lost, there's something called a mean reversion which could happen, but I don't know it'll happen quickly or not. Sometime in the future, I see this coming back, which could take 3-4 years. Also, it's kind of a long-term process. But the sum and substance is that the correlation is kind of lost now, and gold is moving on its own trajectory, irrespective of what happens in the dollar. So coming to silver, which is again my favorite commodity. I've been a vocal exponent of silver prices to rise, and I've been saying this for almost 15 odd years now. It just didn't happen so far, but I think there are lots of factors that are now coming together, and we've seen these long-term levels being broken very easily. And add to that, you have supply concerns, you have huge industrial demand that is ensuring that prices are on the rise, and the same industrial users who took silver stability for granted will again start buying on any dip from here, which is what we're seeing. Any dips are being bought as far as silver is concerned. So it's a 50-year breakout. That's something which we need to keep in mind. Now, again, looking at some of the medium-term projections, I think 63, 65-ish is where a potential, resistance can be seen. I wouldn't say a top, because a 50-year breakout will typically lead to a massive move. And honestly, I won't be surprised if it crosses 75, 80 and all in the near term. But having said that, silver could get quite volatile at times. Not at times, most of the times, and one should be very careful and keep booking profits at various levels. But it's an extremely secular bullish trend at this point in time, like a train without brakes. So it's just headed somewhere. I really hope that it'll go and find some resistance at key levels. But yeah, so 75 to 80 dollars is what we're working with as a medium term to slightly long term kind of a target. But in the near term, I see $60 as some kind of a resistance where it could kind of immediately get capped, and it could lead to some bit of a consolidation for a while. In conclusion, I think there's a lot of upside. Silver has a lot of catching up to do, actually, because if you look at this particular slide, it's very interesting, and it's something which I've used over time. Right from 2021 onwards, I've been comparing this and watching. If you see the pure metals, because silver is also an industrial metal, the 1988 highs of most of these metals, if you compare it with the 2021 high, in fact, now it's even higher than that. Many of the other metals have gone up by 200%, some in some cases 600, some cases even 1,500, like rhodium, and even gold 110%. Silver was down by 53% at that point in time. Now I think it's kind of caught up, but it's got a lot of catching up to do, which is what's happening now. It's more than anything else. It's catching up, and the gold silver ratio, of course, is also favoring silver prices. But even there, I think now it's gradually kind of caught up. So one word of caution is the volatility that one should be wary of as far as silver is concerned, especially retail investors, because I think now it's getting out of the reach because the way the prices are moving, and we should be all the more careful with silver, because when it falls, it can really fall quite sharply. We've seen that before. So one needs to be very, very careful as far as risk management is concerned, and keep working with stop losses ideally. So quickly, I just want to take the attention to dollar index, because that sets the direction most of the time. We see the dollar index coming under pressure and coming towards 90. Right now, it's around 98, 99. I think right from the time Trump has taken over, I think the dollar's taken a sharp beating. Maybe to do with them, maybe nothing to do with them, but then with the debt levels increasing sizably, market is very, very clear that the dollar is not something which is going to sustain at these levels. So we see it coming down even more towards 90 or thereabouts, with some medium-term supports at 95 or thereabouts. So in the short term, again, 95, 96 is something which the markets will be inclined to test in the shorter picture. So in conclusion, the dollar index is something which is looking weak, and that's going to support the precious metals complex going forward. So with that, I'll conclude the presentation. Thank you very much, and hope you could get something out of this. Thank you. Bina, over to you. Thank you.
Yes, thank you, Mr. Gunashekhar, for that insightful and deeply analytical presentation. Your clarity on the technical trajectory of bullion and the dollar has truly enriched today's session. Building on the market perspectives, we now move to a critical dimension of precious metals ecosystem, risk management, and hedging. For this crucial session, it is my privilege to introduce Mr. Shivanshu Mehta, Senior Vice President and Head Bullion at MCX, India's largest commodity exchange and the country's premier platform for bullion derivatives. With over 25 years of experience across physical and financial commodity markets, he has played a transformative role in shaping India's precious metals ecosystem. He serves on the board of IIBH, IIBX, and IIDI and GIFT IFSC, and has been instrumental in serving several pioneering initiatives, from launching the world's first deliverable 1 gram gold petal futures to introducing India's first gold and silver options and developing the MCX good delivery norms for Indian refiners. His contributions to policy market designs and industry reforms have also been significant. Today, we are privileged to have him with us. Mr. Shivanshu, the screen is yours.
Welcome, Shivanshu. I completely endorse all that Bina has said.
No, sir. I'm thankful for such kind words from yourself and sir and from Binaji,
Thank
and
you, Mr. Shivansh.
and a hearty, welcome and greetings to my eminent co-panelists who have already voiced so much on this subject. I will only add 2 cents as as an exchange, which is basically a platform, and I feel that we are mandated by the investors at large to help create this as an asset class, and which is the precious metals asset class and commodities in general. And also, like Binaji said, serve as a risk management platform where the bullion and jewelry industry is able to mitigate its price risk and hence keep its business immune or insured against the base price fluctuations, which have become the order of the day. So while a small disclaimer is that I have no view on any directional movement of this asset class, I will talk about the fundamentals and why it's an important asset class, and also touch upon the risk management aspect thereon. Yes, if someone can help me with the slides, since I'm yeah. So this is just to put into perspective how the Indian, as an Indian exchange, we are actually positioned globally. So you can see that we are at the second largest silver options and gold options contract by the number of contracts traded. This is as per the FIA study. And as regards the futures, the gold and the silver futures in the top five, with silver at the second largest in terms of the number of contracts traded. So this is a country which is known for its penchant for gold and silver investments, as also a very active and evolved jewelry industry. This sort of makes some sort of a perspective there. Yes. And as you can see that the turnover, and I think Gyan Shekhar was mentioning about options having come of age, that's absolutely spot on. And I think we launched, I remember on the day of Dhanteras in 2017, wherein, Honorable, Finance Minister then, Shriyut Arjun, Arun Jaitley ji, had actually launched this product for us. It has, in these 8 years, come of age. And I think the use case for options has really been understood by the jewelers fraternity, especially. And that is being reflected in the volumes. And today we are, for the FY 25-26 on a year-to-date basis, just around 39,000 plus in futures. That is, this is the ADT number, which is in rupees crores, as well as on the option side, about 220,000 crores per day. So put together, I reckon about $30 billion at today's exchange rate is what we see traded in bullion on an FNO basis per day. So that is the sort of pool of liquidity which the investors can, as well as the bullion traders and jewelers can utilize for their respective purposes. Yes. There's some of the highs, numbers are not really so important as the general trend is. We have of course touched on a bullion overall level very recently on the 26th of November, about 21 lakh crores. And this is the options I'm talking about. Yeah, we can go ahead. So, when we talk about this as an asset class, and I think Vikram, Rajni, as well as Gyan Shekhar have touched upon it, and of course, Mr. Chandrasekhar with, his experience, which he carries of decades, has also mentioned about this asset class and the central bank role, which is important here. Globally, it is recognized not just as a metal or a commodity, but also it has a quasi-currency character, which we saw that from the Bretton Woods era, how the prices of gold have factored in not only inflation, not only geopolitical sporadic tensions, but also the currency character, which over a period of time has helped as a store of value there. And most of the currencies in the world, the central banks hold gold as a percentage of the forex reserves, and which is starting to increase rapidly in those countries which had not really done that to that degree earlier. So you can see the various portfolio diversification aspect, international currency character, a correlation which is seen inverse to fixed income and equity, and a response to, as a safe haven response to inflation, recessionary trends, and geopolitical tensions. And the beauty is that this asset class, the price is discovered across global platforms, not only in any one pocket of the world. And as I say this, India, of course, is one of at times second, at times the largest consumer of gold in the world. And the central bank holdings also play a very important role here, like I mentioned. Yes, we can go ahead. So these are some of the factors, as was mentioned by some of the panelists, that the currency character, the inverse correlation with the dollar, the ETF and hedge fund activity, the response to inflation, etc. These factors from time to time have affected the gold prices. Yeah. When we talk about silver, it is more of an industrial metal, and being an industrial metal as well as a precious metal, it tends to have its own share of volatility, and therefore it becomes even more imperative for industry to hedge their price risk. And I need not paraphrase what recently has happened in silver, wherein we saw tremendous volatility and tremendous amounts of physical scarcity, as pronounced in the backwardation, and therefore all the more reason for industry to hedge itself. And we saw a lot of hedging activity, and we continue to see that on the exchange platforms in silver. Yes. Similar factors, apart from the common ones, like I mentioned, the industry character and some of the evolving industrial uses of silver, which are coming through. Yes. Yes, please. Yeah. So here we try to sketch why and how it is a portfolio diversifier, this asset class. If you measure the purchasing power of major currencies across the world, and you index the gold value to 100 in the year January 2000, and you see the currencies and broad commodities relative to gold, you will realize that basically gold is what is something which holds all of that value, and it is these are continuously depreciating in terms of the value of gold. Yes. Yes. Yeah. So this is basically a correlation between the equity markets, and we see a negative correlation. This is well established. We need not go into it depth. Yes. Next. This is the gold rallies in periods of high inflation, specific periods of high inflation. When inflation has been below 2%, gold has rallied. On the left-hand side column, you can see that the annual return is just short of 5%. And when there are years of inflation between 2 to 5%, it's closer to 10%. And when we've had years of greater than 5% inflation itself, you see much higher returns given by gold. Nominal returns. Yes. These are specifically those years in which some crisis event has taken place. And you can see the performance in those specific years of the gold as compared to the dollar index, which is, well, now there are years of, there are talks of de-dollarization, but then we are talking about it as an international currency here, and then comparing it with gold. And you can see the inverse correlation there. And in those specific years, like the oil energy crisis, the Japanese asset price bubble, 1987, and so on, the dot-com bubble, global financial crisis, 2008, the COVID-19 crisis as recently as a 4-year back phenomenon, 5-year back. So you can see gold giving a 24% return then, and dollar index was minus around 7%, and so on. So gold is considered to be the safe haven, gets proven each time these type of events take place. Yes. Now, just to give you a background of why hedging or risk management is so important in this asset class, it is high value, number one, and it also has high volatility. For example, there are refiners who import the raw material doré, they convert it into bullion. So there, and then onwards of that, when bullion gets either sold as bullion for investors or it gets consumed by the jewelry industry to churn out jewelry, which is a value-added product. All of these value chain stages involve risk. And just to give you an example, if a firm in gold business with an annual turnover of 1,000 crores, which is not much at all now, considering the prices, so just an example, it would be exposed to a risk of 170 crores out of that 1,000. If you look at the volatility prevailing in 2025, which is 17%, this is the rupee price volatility. Similarly, if you see a firm dealing in silver and it has, let's say, a smaller turnover of around 100 crores, and it was exposed to the 25% volatility this year has seen, then approximately 24, 25 crores would be the risk it would be dealing with. So therefore, this kind of a percentage of risk is way above the fabrication margins of these industries, and it becomes highly imperative for them to manage the risk via bullion derivatives, which is futures as well as options. Yes. So if you can see, the prices on MCX are today used by the value chain, and the pricing is done by the MCX plus minus. And you can see that the importer stage, importers to bullion traders all the way to jewelers, they use this as a reference point. This covers the import duty, the exchange rate, as well as the prevailing domestic premium gets reflected in these prices. So it's a three-way hedge actually. And the trading hours in MCX are so that we see the entire globe's movements happening during the course of a day. Yes. Next, please. So we have a product in each denomination from 1 kg to 1 gram in the case of gold. We have the 1 gram, 8 gram, 10 gram coins, and we have 100 gram and 1 kg, which is more of a B2B product. And on the silver side, we have the 1 kg, 5 kg, as well as the 30 kg. And interestingly enough, these contracts come with an electronic accumulation SIP type of flexibility. You can hold them electronically. They are quality assured products for retail. They come along with assay certificates. They are in a packaging which is tamper-free, tamper-proof, and they are free from any counterparty risk, which creates a retail instrument as such. And we have seen that happen in the silver, especially 1 kg, which we launched, kilobar. We have seen more than 570 metric tons of silver delivered. And all of these contracts are used by small, medium jewelers across the country, as well as listed jewelers, as declared in the LODR for hedging. Yes. Yes, please. And options, you see, coming to options, why they have taken off, because they are a flexible instrument. You pay an insurance premium, and you actually are, left with a flexibility to be profitable as well as to protect your downside. This, in essence, is a difference between options and hedging via futures. So both of these instruments are used in tandem by the industry to hedge themselves. Yes. And what are the, like I said, we have an options on futures basically. So they devolve back into futures. They create a better cash flow management. The money can remain where it's required in the business, low transaction cost and low capital intensive. Yes. Yes. So we have 4 different option products, 2 each in gold as well as in silver, 1 kg, 100 grams, 30 kg, and 5 kilograms. And you get shorter tenors. We have monthly expiries, which we have launched last year, and we have seen that it has really helped to increase the retail participation, rationalize the premiums, and the turnover you can see has gone up multifolds. It actually created a platform for retail to come and participate for its own type of usage, whereas the hedgers have come and written the options to actually create a beautifully liquid platform, and that reflects in the numbers. Yes. So these are very quickly the things which dwellers or industry is doing for hedging via options. One is an approach wherein they lock in a certain range, they protect the upside as well as the downside, which is called a costless collar activity. Dwellers have been very important point here, using flexible pricing schemes during season of Diwali or Akshaya Tritiya, using put options to give a flexible price, lowest price of a particular time zone for their walk-in customers. People are monetizing or hedging their inventories by using options. And whenever the volatility is high, the implied premium on the options goes up. At that time, people normally write options, and when the volatility is low, they hedge by paying the premium of buying options. So options creates that much flexibility to a hedging portfolio. Yes. Yes. So this is just an example. I think we need not get into numbers. The idea is that even listed dwellers today, and I don't want to name any particular dweller, but various dwellers are maintaining a healthy open interest only for this flexibility to be offered to the walk-in customers. And nobody loses out. It's not as if one party is benefiting at the cost of the other. The premium, it gets consumed as a one-time admin cost, and the jeweler is able to offer such a huge range of prices. It works very well for the end consumers as well. Flexible pricing. Thank you. Yes. Next, please. Yeah, this is just a delivery is basically a compulsory delivery contract ensures spot to futures integration. We have had about 155 tons of gold and 5,900 plus silver tons delivered on MCX. We have launched the India Good Delivery Standard, MCX Good Delivery Norms for the BIS approved refiners. We saw about 13.8 tons delivered of Indian gold delivered on MCX, valued at close to 9,500 crores. And like I mentioned, we have seen, the 1 gram contract, which we are the only exchange which has a deliverable 1 gram, the first one, I should say. And we've had 645 kilograms of 1 gram gold delivered and 585 tons or 5,85,000 bars of 1 kg silver delivered since inception. This is mainly for the retail that we are mentioning this. Yes. And just last slide here to leave a thought for the hedgers that the physical books that they carry, they are offsettable against their hedging positions as per the section 43/5 of the Income Tax Act. And they are no longer forced to undertake physical deliveries to prove that their transactions are in the nature of hedging. And this needs to be further seeded and awareness needs to be created so that the order books and the business fabrication margins are better protected, and these positions are actually considered as business income or loss. They're offsettable against them. Yes. Thank you. I think that covers my portion. Yeah.
Yes,
Thank you.
thank you. Thank you, Mr. Shivanshu. And without taking much of your time, I know you are in a hurry. Mr. Chandrasekhar just informed me some medical urgency. So we won't take much of your time, but I will check up with the audience or with our panelists in case if they have any questions so that you can move ahead.
Sure,
So
please.
we can request our Mr. Chandrasekhar ji, do you have any question for Mr. Shivanshu?
No. And when a speaker has no questions, it means that he has left no one.
Everything is very clear.
Okay. All right. But Shivanshu, thanks. That was an interesting insight into what MCX is doing. All the performance of MCX, at least as far as precious metals are concerned, the credit should go to Shivanshu. Thank you very much. I know you have to leave. Go ahead. No worries at all.
I'll take one question with him before he leaves.
We will
Because
probably write to you. We will write to you, and you can respond later at leisure. I don't see any questions coming.
okay,
I think thank you so much, sir. But Binaji has just since
I
pointed out.
have one question, which will be very simple thing. Among
Right.
hedging tools available on the MCX today, which strategy do you think is being underutilized by the dwellers or the industry people or trajectories?
Good
Amongst
question.
all the strategies, which is
Okay.
underutilized?
Yeah, very interesting question. I'll quickly address that.
Yeah.
Actually, what I have sort of come to understand is that traditionally, before gold started becoming very volatile, let's say you leave aside the past 8-9 years, what dwellers used to come with a sense of belief that whatever inventory we have, it's a given. It has come down to us from our forefathers, our ancestors. And if I maintain, let's say, 20-30 kgs of gold in my shop, some of it gets sold, some of it gets back to back bought, and this is increasing value anyway. So I'm sort of quasi hedged, but that has dramatically changed. You see, now you see two-way movements in gold and silver, which are often, for want of a better word, even violent in nature at times. So their valuations, their order cycles, everything is prone to a high risk, especially their margins. So now there seems to be more of a sort of an understanding or awareness among them that look, we can't just go by that thumb rule anymore. We need to value these things at every financial cycle. We need to protect them and show for the protection in our books. So they have started using put options, etc., for the purpose of valuation of their inventories as well. This is a healthy trend which I'm seeing. And some of them, they declare their hedging, the listed ones, as per the LODR requirements in their annual reports, etc. So this is something which we are finding encouraging, and it must continue because it's a very important industry for our country in terms of GDP contribution and even the export of jewelry. Yes.
Thank you,
One
Shivanshu.
one question, Shivanshu, while you are here, before I let you go, platinum and palladium. What is your thought? What is your plan? How do you promote? How do you propose to promote risk management in platinum and palladium?
Yes.
Are you happy with the current volumes, or is there a scope for promotion?
No, yes, sir. Very valid point. In fact, platinum is already something which we have discussed with our product advisory committees, and considering that the volumes in India are relatively thin, we are looking at various settlement price methodologies. So that study is underway, and it will be again placed for the consideration of our product committee, and subsequently it is definitely high on our to-do list. Yeah.
Right. Understood.
Thank you. Thank you, Mr. Shivanshu. We won't take much of your time.
Thank you.
Same
Thank you.
palladium. Same for palladium.
In due course, sir. That is even narrower, but it is again in the
I know.
state, sir. Yes.
But with this EV and all that picking up, of course, in India, penetration of EV is quite low. But yet, I'm sure going forward, demand will pick. Anyway, okay, I'm sure it's on your radar.
Yes. Yes.
Binaji.
Okay, we will allow him to move on because he has a medical urgency. We cannot make him wait that long. Thank you, Shivanshuji. It was really researched and very insightful presentation, and we look forward to your continued support and coming in our future webinars also. Though
Yes.
we have a very short number of low number of people, I would say, though there were a lot many registered, but I would say we have a very quality speakers where we were having very rich content, and of course, when we put on a YouTube, we get a wider exposure. Thank you so much. Thank you.
God bless. Perfect.
Now, staying with the theme of navigating the future of precious metals, we now move to a broader global outlook. Gold in 2026 and beyond market. Mr. Hiren Chanderia will present his views on this subject, focusing on the macro forces shaping gold's trajectory and how investors can position themselves for stronger returns in the coming years. Mr. Hiren Chanderia is Managing Director, Middle East and Asia Operations at Monetary Metals, a company headquartered in United States that enables investors to earn a yield on gold paid in gold. Based in UK, he is a Sloan Fellow from London Business School and CFA charter holder. He then has held the leadership role across trading funds and market infrastructure, including Nippon India, Mutual Fund, GoldX, Muthoot FinCorp, NCDX. He has also led strategy roles with several game changing fintechs globally, bringing deep expertise in precious metals, sustainability, and financial innovation. Mr. Hiren, the floor is yours. I know I made you wait for a long time, Mr. Hiren, but I think the last title is always a very important one.
Hey, thank you for inviting. Good afternoon, everybody in India, and good morning, good evening in the rest of the world. Thank you. It's a great pleasure to be here among this eminent panelists. And let me share my slide. Okay. Okay.
Need any help?
No, I think so. Okay, allow. Are you able to see my slide?
No.
Screen, yes. Yes.
Perfect. Okay.
Yeah.
Hi.
Yeah.
Thank you. So I joined Monetary Metals recently on Dhanteras. So a very auspicious day to buy and do anything with gold. It's been a very interesting journey so far. This is one of the companies which has turned around the full philosophy which we talked about in saying gold is not a productive asset. We are trying to make it productive, and we have done quite a good job globally in terms of making it productive. The company has been in existence since 2012, started by Keith Wiener, who is an entrepreneur, a founder, a very enterprising individual who designed the whole mechanism to make gold a productive asset. And let me now focus on the content of this presentation, which is on gold. Okay, so if we are talking of gold market, it's very difficult to not talk about the overall picture, right? If you look at the total quantum of gold mined till date and lying everywhere, it's around $30 trillion. And if you look at it, around 45% lies in jewelry. Now, each of this sector is very, very important. If you look at jewelry, I don't see people selling jewelry when prices go down. So that does not come to the investment market as such. Then you have central banks. Now, these are the major drivers of gold. And what has happened off lately is, if you look at India's import, or many of the major consumers, India, China, they import a lot of gold when prices correct. And that provides a very good buffer for gold prices to move up. That trend was very, very true until recently, and it's still true, but the limelight has been taken over by central banks right now. So if you look at the change in the central bank's gold holding, it has, as Rajni pointed out, it's around 37,754 tons, 55 tons at the end of 2024, which amounts to around $5 trillion or 17% of all gold. This has been a significant change, almost 21% uptake since 2014, right? 21% increase in the central bank's holding. And that has been changing. If you look at, we'll come to that slide later. I only have 4 slides here. And this is my favorite slide, right? So we will be talking about central bank slide. We'll be talking about how it happens, but what is happening currently. But as we speak, central bank is one of the main drivers of gold prices of lately. And there are reasons to it, which we'll come to. If you look at private investments, it's divided into two: bars and coins and ETFs. And there is a 88% increase in last 10 years in the ETF space. Okay, so that is very, very important. And bars and coins are almost resilient. Even if prices go up, prices go down, bars and coin demand almost remain stagnant and keep increasing at a steady pace. So that's very interesting. ETF to an extent reflects the investor's psychology and how market is performing. You have other sectors which talks about industrial application and other places where the demand is almost always constant. So overall, from this slide, what I'm driving home is jewelry market. People don't come out and sell jewelry. Jewelry market does taper off a little when prices go high. But as we know, most of the jewelry consumption nations like India, China, Turkey, people tend to buy a lot of jewelry when prices correct. And irrespective of the prices, if you have a function in the family, a marriage in family, then jewelry has to be bought, right? So that keeps happening. In terms of central banks, we talked about that, bars and coins, ETFs, everywhere the demand is going up. I don't see any major changes happening there. The only tectonic shift which has happened off lately is over last couple of decades has been central banks have bought a lot of gold. And that is a significant change. They had been net sellers of gold, selling up to 4,000, 5,000 tons of gold, and suddenly they have started buying gold. So that is a very major shift in this thing, gold market. So overall, around 30 trillion worth of gold. Compare that to global financial assets, which amounts to around 300 odd tons of gold. So, and out of that, if you look at ETFs and private investment, that is the main important thing which we need to talk about, and that we'll do. So, what happens there? Globally, the global portfolio is diversified approx to the tune of 2% in investment. I won't consider jewelry there. I won't consider other assets, but in terms of bars, coins, ETFs, that is where 2% of the global portfolio is diversified. Now, if you want to look at what Rajni was mentioning, around 10%, you can assume where gold prices will shoot up. So gold price is shooting up to that amount would result in around 3-4 for each percentage. We are increasing around 3% in the gold investment, and that could really in 3% increase in investment is quite significant, and that can result in prices going up like crazy, right? That's what is, I believe, would be the driving factor in gold. So gold is translating from predominantly a luxury good to a monetary metal. That is what is happening in the markets right now. Now, if you look at the gold shares in official sectors, if you go a decade back, around 53% of the reserves were parked in US dollars, global. And right now it's around 46%. And this has been gradually shifting. And that is what I mean by tectonic plates, shifting under the core, right? And that is resulting in way higher gold prices than we envisaged, than anybody expected. If you would have looked at any of my presentations going back a few years, I would have told that I won't put a price to how high the gold prices are going to go, because if I put it, nobody would believe it. And if I don't want to put a cap on how high gold prices can go. I'm not saying that it would continue going high. It could continue, it would correct, it's possible to correct, it would correct, but there are buffers in place which not many other asset classes enjoy. Like, for example, if you look at jewelry, the consumption increases. And if you draw a chart of gold price vis-a-vis the jewelry demand, you will see the imports in India, countries like India, increases. And after a lag of a quarter or two, you will see international prices going up. So that is typically what keeps happening. So that is there. Then second is, you look at countries like China, Russia, who has increased their gold reserves very, very significantly, and they want to diversify away from US dollar. You look at the trade war, you look at the currency debasement which is happening currently. It makes a little sense for most of the global central banks to diversify. And you'll see, barring Europe and US, most of the central banks do not hold that quantum of forex reserves in gold. So that's very, very important. The diversification is predominantly dominated by diversification away from US dollar, and currently gold has taken over euro as the second largest forex reserves. I mean, it has second largest share in forex reserves. So that's very, very significant, which has happened off lately. And what also happens is, when dollar depreciates, it makes gold cheaper for non-dollar denominated countries where gold is purchased, and that provides a little bit of smoothing over the gold prices. We always see gold prices in dollar terms, but when we see it in Indian terms, it's a little more smoother, because as Vikram pointed out, as Rajni pointed out, dollar and gold are a little negatively correlated most of the times. At times they are not, but most of the times yes, and that smoothens the curve. So gold becomes cheaper when dollar depreciates and rupee appreciates from the Indian perspective. So this is the main thing which is driving gold prices higher, in my opinion. Now, if you look at the central banks, right, look at the change over the last 10 years, what has happened in central banks. The main focus has been in Russia, China, which has increased the reserves by close to 29%, right? 29% increase in forex reserves for a country like Russia. China increases reserves 7.7%. That's quite a significant jump. India, Turkey, Poland, Kazakhstan, Saudi Arabia, all of these countries are increasing their reserves. And compare this increased percentage of reserves, compare it with say reserves from US, Germany, France, Italy, Austria, Netherlands. It is quite low, still quite low, right? So if China alone wants to increase its reserves by 2%, it would eat away a couple of years of mine supply. So that is the kind of trajectory we are in. And talking about the mine supply, it's very important to note that mine supply is almost always constant. It takes around 7 to 10 years for a new mine to come up. So irrespective of the prices, a lot of productions would not be coming into the system. Only thing which mines which are sitting on the sidelines, which have higher cash cost, would be coming in. Otherwise, I don't see much of the production coming in. And demand from central banks is one of the main things which would be driving gold prices. So I believe central bank is taking away the limelight from private investors in terms of the gold price movement. And that is a spiral. In terms of when central banks buy a lot more gold, investors would buy a little more gold, and the spiral would continue going up, and they act as an excellent diversifier. So that's one thing which I wanted to point out. Okay, which are the other factors which drive gold prices? Rajni has already spoken about it. Rajni mentioned that portfolio diversification, low correlation. I think Vikram also touched upon that. Interest rates, real yields, which are low. I don't want to touch upon this in terms of inflation. I just wanted to point out one particular instance in inflation, right? We talk about the sophisticated inflation numbers. We talk about how inflation helps, but in a very layman's term, how do we look at inflation? Inflation is nothing but how much a person requires to sustain the family. For example, if you look at the price of gold, 10 grams of gold in Indian terms would sustain a family of 4 for a period of 1 month over centuries. This has hold true 100 years back, probably 1,000 years back. It's the same thing that holds true, and that's how I consider it inflation. In the global parlance, when I'm talking to audience globally, I say 1 ounce, which is around 31 grams. So 31 grams of gold in UK would be able to sustain a family of 4 for 1 month, and this has hold true throughout centuries. So that is what I mean by inflation. That is what really, really matters. So geopolitical risk, sanction risk, which is currently trade war uncertainty, what is happening right now, I don't know how much time we have been now, but I can touch upon Japan and peculiar behavior of gold. These are the two other things which I can touch upon if you want. Do we
Yes,
have?
you can certainly touch upon because you're the last speaker and we don't have many participants for questions, so we'll save time on that. Though we are a little over time, but yes, I would like you to continue.
Perfect. So, in terms of what has happened in Japan recently, Japan has almost zero interest rates. So people used to borrow in Japan and invest in all the rest of the market around the world. And recently, Japan has signaled, just by signaling that they are going to raise his interest rate, that whole things fall flat on their face. So people have started removing money from outside from all financial assets, bringing back to Japan. That all things has happened, and that has resulted in the current upheaval in the markets. In terms of gold peculiar behavior, uh, gold is a very, very interesting commodity. So why I would say is the biggest risk right now is if anything goes wrong in the financial markets, golds tend to fall first along with the financial markets and then it rises. Why does that happen? That's a very, very peculiar thing which keeps happening over and over again. The probable reason for that is when a big hedge fund or big conglomerate is invested in financial assets across the world, when their global stop losses hit by any one asset classes, they generally exit all the positions around the world. And when they do it in a very, very quick and swift way. So the all prices, even their holdings in gold are I mean, they sell all their holdings everywhere. And that is why you see gold prices generally correcting along with the financial markets at the very start, and then they start moving up. That happened in 2007, then happened in 2012, 14, and it keeps happening. So I won't be surprised it would happen again right now. And that's a very, very peculiar behavior. So don't be surprised if you see a little bit of correction in gold. But gold, let's be honest, who buys gold for short term, right? If you're buying physical gold, bars, coins, ask your friends, family, better half, how many times have they sold their gold because prices went up? I don't think so. You will hear so many yes that okay, prices have gone up. Let me sell my gold. Let me sell my jewelry. That's not very likely to happen. So gold is something. The above ground stock of gold, around 30 trillion worth of gold, keeps increasing by around 2% annually. And if demand is increasing by more than 2%, then I think we can make a safe case for gold bullishness. What could, as Chandrasekhar ji pointed out, what could drive gold prices down? Okay, the most important risk to higher gold prices is if the trade war is taken care of, geopolitical risks are down. If there is a risk on environment again, where people start investing in financial assets, which are doing quite good right now, but valuations are a little expensive. So that would be the main risk factor, in my opinion. And lastly, I wanted to touch upon the disclaimer that these are all my personal views and not necessarily monetary metals view. Thank you.
Thank you, Mr. Randeria. That was really interesting. And with this, I think speakers, if they have, sorry, audience, if they have any questions, we can unmute them because I don't have any questions in the chat from them. Otherwise,
I have a question for Gnaneshekar.
Okay.
If I have heard him correctly, he's not bullish about the dollar. He expects the dollar to weaken going into 2026. Did I hear you correctly? You're saying the dollar index will fall well below 100. It's 98 or whatever currently. Is that right?
Absolutely. I think it's going to come to 95 in the medium term and possibly 90 in the slightly longer term picture.
I am actually somewhat bullish about the dollar going into 2026. Two things. One, Trump's policies of imposing tariffs have already had their effect on reduced imports into the US. Number one, Trump's tariffs have also generated revenue for the exchequer. Therefore, the twin challenge of trade deficit and fiscal deficit will not expand but will narrow. This is something which is, in my view, going to send a very strong message to the world about the dollar. I don't expect the dollar to weaken. The dollar will stay relatively stronger vis-a-vis the euro, vis-a-vis the pound sterling, certainly vis-a-vis the yen, etc. This is again my view. I'm not you. You are the forex expert. I'm not. But from the macroeconomic outlook that I read about the US and the global economy, I have reason to believe that the dollar will not weaken from its current status. Second, there is another question. All of us have talked about inflation and gold as a hedge against inflation. When inflation rises, we say buy gold because it's a hedge against inflation. When inflation rises, obviously interest rates will also rise. Okay. Now we are in a situation where inflation is not rising, but most likely the Fed might cut interest rate and other central banks will follow. Here also we are saying because interest rates are going to be cut, gold prices will go up. So, I mean, to me, it's a kind of paradox that it is a hedge against inflation. Because there is inflation, gold prices will go up. And on the other hand, if inflation comes under control and interest rates are cut, again, that gold prices will go up. I somehow find this doesn't gel as some kind of a contradiction in this. I'm not sure if Vikram will put it in perspective. Is there anything fundamentally flawed in my understanding? I don't know. Yeah.
You would have been absolutely correct before COVID, but after COVID, everything is broken down because. Let me give an example.
Yeah.
Today, as Hiren pointed out, and very beautifully put by Rajni and to some extent by Yamshekhar also.
Yeah.
See, first of all, it's amazing session, and I think people who didn't join missed quite a lot because I learned a few things today. I mean, I've been in this market for as long as my hairline has been receding, so you can imagine it's been a long time. So excellent, very good presentation to everybody. In fact, I was the most unprepared in this, and I apologize for that. But I think to answer your question,
You're not alone. Okay. Yeah.
So to answer your question, why things have broken down after COVID? The answer is very simple. The intervention by the central banks and the governments have become more profound, whether it was Bidenomics, now Trumponomics. We also keep on having these little experiments in India, PLI or, sometime it is fiscal tightening, sometime it is easing, sometime it is monetary stability, rupee, etc. So the intervention is, it's like a fund which is managed by market dynamics and a fund which is being, fiddled with every day by the fund manager. So which will be more predictable? That is the answer. And I think to my mind, what everybody has been mentioning, it will get only worse. Because what they have started, they can't leave it now, especially if we see some sort of a black swan event. We don't know where it comes from. The intervention will only increase. So I think we are actually seeing a market which is being completely, distorted by the central banks. So that's why these things don't matter. It will matter eventually. Mean reversion will take place. But I would say don't read too much. Don't bet your money based on macros as of now.
Right.
If I can add to that.
Please go ahead.
Yeah. So see, how I look at things, I may be wrong, but I think there are different audiences we are catering to. When we are talking about inflation, we are talking about protection, hedge against inflation, right? So it caters to a different set of audience. And when we are talking about real interest rate, what are we talking about is opportunity cost of holding gold, right? If the opportunity cost of holding gold goes down, it sways investors away from other assets into gold. So there are two different kinds of audiences, and as we can see, gold plays an amazing role in so many other dimensions as well. It's not one asset which is only looked at a financial asset. At times it's looked at hedge against inflation. At times it's looked at hedge against trade wars, at geopolitical risk, everything, right? So it caters to different kind of audiences, and depending on what we are talking about, if we are talking about high inflation, we are talking about hedge factor. But the moment we talk about interest rate, we are talking about financial returns, and that's a different set of investor class which comes into play. So I believe that's why you hear both this argument.
But any commodity globally has multiple drivers. There are at least 6 drivers, if not more. And each one of these drivers, they either operate singly or jointly.
Correct.
And they all cumulatively operate, but with varying levels of intensity to
Correct.
impact commodity. So perfect. Makes sense. Binaji, will all this go on to the YouTube?
Yes, on the YouTube.
I think that's where, as Vikram said, I think it will be a
And just
huge.
summarize the facts and put it in the market blog with all the presentations. I think overall it was a very, very interesting session. And if I sum it up, so volatile is far from getting over. So that is what of the theme was, will the glitter get over? I would say we are still going to continue in it. So I would like to thank all the speakers for sharing such valuable insights, and thank you to our audience for your time and participation. We hope this session helps you navigate precious metals landscape as we move into 2026.